when we did this campaign with the thought that we could actually win is that we inspire other people to do the same thing. The idea that other people can find great directors, they have a great argument, and they put that in front of large shareholders and give them an opportunity to really affect change.
I'm Bethany McLean.
Did you ever have a moment of doubt about capitalism and whether greed's a good idea?
And I'm Luigi Zingales.
We have socialism for the very rich, rugged individualism for the poor.
And this is Capital Isn't, a podcast about what is working in capitalism.
First of all, tell me, is there some society you know that doesn't run on greed?
And most importantly, what isn't?
We ought to do better by the people that get left behind. I don't think we should kill the capital system in the process.
I've long been interested in the question, if a company's shareholders are its owners, then surely they should be able to get that company to behave in ways that they like, whether we're talking executive compensation or climate change policies. But aside from some activist investors who usually have very specific issues, shareholders often don't do much with their considerable power. Regardless of the explanation, shareholder floppiness, Luigi, is there a better word, is an issue for capitalism, which is why we were so pleased to see the story of Chris James, a former hedge fund manager himself, who has created a firm called Engine No. 1, which calls itself a socially responsible activist hedge fund.
It used to be that ESG meant screening out companies that don't comply, but lately activist investors are screening in companies that would be the antithesis of ESG, like big oil, and then pushing for changes. That's what's going on at Exxon right now. A new firm called Engine No. 1, led by an under-the-radar hedge fund manager, Chris James, is running a proxy fight seeking to overhaul the business.
Chris's partner, Charles Penner, picked Exxon, which has been struggling with losses as oil and gas prices plunge, along with a lack of strategy for renewables, as their first target, and they succeeded.
Hedge fund Engine No. 1 has gained a third seat on the ExxonMobil board of directors. The small fund campaigned on environmental concerns, ESG, of course, the idea that Exxon is simply not doing enough to address that in its business.
They were actually inspired by a paper of yours, Luigi, right?
Yes, so they say. I'm flattered by that.
Tell us about it. Why?
So since the 1970s, since the famous article by Milton Friedman, everybody thought that if you take the perspective of the shareholders, what you want to do is maximize shareholders' value, the profits that a company generates. What we point out that even if you take a perspective that shareholders should be first, or precisely because you take that perspective, you might want to consider the fact that there are some situations in which shareholders want something else. If I am 100% owner of a company, I don't necessarily maximize profits. I certainly want to have higher profits, but I want to also have happy employees, or I care about the local opera community or something else, okay? Now, Friedman points out, you maximize profits and then you distribute these profits as dividends, and then shareholders can do whatever with their money. Now, we show that this idea of separation is true only if there are no synergies or benefits to do the two activities at the corporate level. So if it comes to donating money to your alma mater, whether you donate $1 as a corporation or you donate $1 as Benedict McLean, the dollar is still $1. It doesn't make a difference. However, if it comes to, for example, pollution, if you maximize profits and pollute, and you, Bethany, care a lot about undoing that pollution, you probably spend much more in undoing that pollution than they made in profits doing the pollution. So at that point, we want to consider not just maximizing profits, but maximizing your utility. And if you are a bit pro-social, in your utility, there is something else other than money. There is also maybe the welfare of your community, of your country, or the environment, or whatever. In that situation, even if a company only care about the shareholders, they need to ask the shareholders what they want to do. This might be different than purely maximization of profit. So it's a simple distinction, if you want, but enough to create a wedge between the mantra, you should only maximize value, and a more broader approach that shareholders care also about other things.
Yeah, I do wonder, and let's go talk to Chris, but I want to come back to this after our conversation with him. I do wonder how many companies are as flat out stupid as Exxon. And it seems to me from what you're saying, maybe they're a fair number, but the CalPERS managing director for board governance and sustainability, and CalPERS ended up supporting Chris James, said that the two key things that made a difference, the critical reason they were willing to support Chris James, were Exxon's unwillingness to engage with shareholders. So they're no, hear no evil, see no evil, speak no evil, and also the focus on future performance, the focus on money in the future, that this was in the end a financial issue. And so those two things made me wonder how broadly applicable this strategy is. But let's talk to Chris and come back to that.
So I have to admit that I screwed up during the Chris James interview, and a cable was not connected. So we are going off our backup recording and not the higher quality usual recording.
And I'm always so happy to have somebody else screw up technology because I'm usually the one who does it. So all I have to say is, yay, Luigi, that's awesome.
So I think it would be nice if you were to describe us the Exxon story in your words, because we know the story, but our listeners probably are not as familiar as they should about this story.
Yeah, the original idea around the ability to affect change with Exxon came from Charlie Pinner. And Charlie had done a previous campaign with Apple. And I think we spent a lot of time walking through how do you tie these impacts into economic outcomes. And we had kind of a mind meld over how that was actually going to be done. The framework which we developed, something we called the total value framework. If the company was able to change course and accept that the energy transition was going to take place, and then have a board members who had experience within energy and creating value in the energy space, that message would resonate across all shareholders, primarily because the company had refused to engage with virtually every shareholder, whether it was an active shareholder, whether it was an index fund. Over the course of the previous decade, and even under current leadership, there was very little dialogue between management and shareholders. And so we felt that we could kind of harness that frustration with management's unwillingness to engage with many shareholders, and the idea, which is just common sense, that an energy company should have people with, at least some people with energy experience on the board. This is a company that had no one with energy experience on the board, which is in and of itself, tells you a lot about that kind of the culture of the company, where they didn't really want to be questioned. And so we took the idea that shareholders were frustrated with the performance, the large index providers were frustrated with the lack of dialogue and acceptance that the world was changing, and harnessed this into a message where we didn't talk about climate change as an ideological issue. We spoke about it consistently as an economic issue, because it is an economic issue over the course of time. And we were able to win 3 of the 4 board seats with the support of the 3 largest index funds, support of ISS, support of Glass Lewis, and many active managers, and by far the majority of active managers with the top 15 shareholders, which was something no one thought was actually possible. But obviously, well, we thought it was possible, but I think we were the only person. But we did a very simple Bayes probability model on what happens if you win 2 of the big 3, what happens if you win 3 of the big 3, and then we kind of would knock off the probability of each of the big active shareholders. And the fact was, if we won the big 3, there was a 85% chance we were going to win. And by the way, no one for some reason did that calculation.
What is the strategy your fund is pursuing, and what is different with vis-a-vis what other activists do, and what is new about it?
Yeah. For the firm, we have several strategies. The concentrated equity fund is certainly one of the strategies, but the overall idea here has always been across the firm to affect systems change. And systems change takes multiple paths to actually do this, one of which is our ETF, one of which is our concentrated strategy. One is kind of the model which we call active ownership. Charlie Pinner runs that, and he ran the Exxon campaign, the day-to-day, the hard grind, the letters, all of these components of the overall firm strategy. And then we have what we call the foundry, which is building company from scratch, and private equity, all tied to the same simple idea, which is that the long-term value of companies is a function of the total impact that companies have on society in general. I don't know if you've read this anywhere, but the initial inspiration for the firm and for the overall idea was partially done by the paper that you and Oliver did. And that basically became our investment framework, which we've kind of further developed into a very data intensive framework, which really looks at as best as we can, externalities or impacts and what effect they have on long-term value creation. So multiple strategies.
Does there have to be a component of value creation to this? In other words, if you think about broadly ESG goals, would you guys be interested in something that arguably was good for society but didn't have a financial benefit as well? And I'm thinking about this through the lens of ExxonMobil, where you could argue that their strategy of fossil fuels, yes, bad for the environment, but also bad for where the world is going on a financial basis, given the move to renewables.
Yeah, I don't think you can unlink the two. We believe very strongly that many issues and many reasons we have not seen change is because the discussions have become ideological and they've split across party lines when the simple fact in front of them is that there is a linkage between long-term value creation and impacts. It's not a coincidence that the big debate of the last 10 years among divestment or engagement has been around fossil fuel companies. And these companies, these stocks, have been horrible performers over the course of the past decade. I don't think it's just a coincidence. Yeah, I think the linkage, at least in our case, we believe the linkage sits there for most companies, certainly where there's transparency. And transparency is the vital part of this. Without the transparency into what impacts really have, and that's what the data revolution or the ESG revolution as well has really done, is it's given us a lot better data sets on what impacts companies actually have on society at large.
I'm certainly very flattered by the reference to my paper, but in our paper, we do point out also that there are trade-offs, that sometimes you want to work for the environment at the cost of profits if this is important enough for the shareholders. Where do you see the trade-off, or you see there is no trade-off, is all a sort of win and win situation?
Yeah, well, I think the trade-off, which I think you pointed out in the paper, I think it was around the short term. So there are certainly trade-offs over the short term, and there is a J-curve associated with companies when they actually realize what the impact is. I mean, 25 years ago, I mean, none of us really understood what the impact of climate change was actually going to be on society. And I think over the short term, there are trade-offs, and the quicker companies actually realize what their impacts are and then how that will affect the marketplace in which they play in, the sooner they actually understand that, the better off they're going to be. We look at we call it internally the path of the impact, which is what happens when people realize that whatever this company is doing has a large negative impact. And we have regulation, governments get involved. We have consumers change behavior, early adopters. And this is, of course, like the people driving the Prius. And then you have innovation. And the innovation is to mitigate these impacts. And so we kind of look at the intersection between innovation and impacts as the place where we think that we have the most ability to drive change, because just like we saw the original clean tech revolution, the idea was how are we going to mitigate these impacts? And then once we started doing that, even though it took a large amount of pain over the short term, but over the long term, these companies are the ones that are driving the disintermediation that's taking place in the energy markets. So we do think that, yes, there are short-term trade-offs, short-term investments, but we think over the long term that the impacts are, and how you mitigate those, and the speed at which you do this, and the speed at which you realize change. I mean, look at the energy industry. Look at Ørsted or Equinor versus Exxon in particular, where Exxon has been the last person to actually talk about the desire for society's, what they call it, the low carbon solution business. This was the last oil company to do this. And look at the first ones, which were the Europeans, and they've been much more successful in the transition. Certainly the first movers, which started, almost 10 years ago.
In a market that increasingly values the short term, or always has valued the short term, how do you plan to mitigate that issue in your public market funds, where you have a lot of pressure around short-term performance rather than just long-term performance? And specifically to the energy industry, if you think back over the last 10, 15 years, there was at least briefly a reward for fracking and for incredible production driven by fracking. And how do you mitigate that trade-off between short and long term? The pressure from other investors?
Yeah, I think that there's a shift underway. And one of them has certainly been the fact that index investors, the big three, their time horizons, if you're an index product, are virtually perpetual. And as we've seen during the last proxy season, these companies have started to vote over for not just our own directors, but within the proxy season were much more aggressive in voting for issues that they viewed as important to the long-term performance. So yes, while on one end of the spectrum, you have short-term traders, or you have the platforms, the Citadels and Millenniums, which have, short duration. And then you have this move to the long-term index, and the size of those, certainly within companies that are in the S&P 500, are definitely driving. It's a very differentiated market, but and there's a gap there in the middle, which is no man's land, which you really don't want to play in. But I do think the market is bifurcating between the very short term and the very long term, and the very long term are growing faster. But for us as a firm, it's really having the right investors. If people think that we're going to be able to affect change dramatically for large companies over 3 to 6 months, they're going to be very, very disappointed. We think that change for a company, any large company, takes probably 7 to 10 years, and that's certainly the expectation that we have, and we have to find investors that are aligned with those goals.
So is it fair to say that index funds, instead of being a force for the status quo, are becoming a force for the greater good, or is that too broad a simplification? I
think it's probably too broad right now, but they can be. The voting process in general, as we know, has the fact that the ticker vote, which for our index fund was available, kind of tells you the level of prioritization that people put on what their own vote was. Which leads to an interesting dichotomy that has kind of existed, which is that many of the people that we're talking about divesting last year or in the previous years are the same people who were also talking about making sure you get out and vote for the presidential election. And the idea that by divesting and giving up your vote, that is going to affect change, I think is an insane idea. So I think that there is the possibility for index funds in general to be a positive force for good. There are some limitations, though, on what they can actually do, because they cannot be active in the same way that we can be active. You have to file a different regulatory filing. It causes an enormous amount of problem inside the company when you have a vote that exists across the whole firm. But they're clearly moving the right direction. The pace of which is yet to be determined. But we certainly hope that people don't lose faith in the capitalist system before we see these sort of changes actually take place. And I think a big part of that change is going to have to be restoring some equilibrium between shareholders and management. And right now, that equilibrium is way out of whack, primarily because people haven't really paid as much attention as they really should during the proxy season or during voting, and realize the power that they ultimately have. Right? If you give your vote to a big institution, you kind of feel like they're going to vote for a big institution. So in many ways, I think people have become disillusioned. And what we want to do is bring visibility to the power of the shareholder, and especially the long-term shareholder. And as we saw with Exxon, that is a powerful tool that people actually have to affect change, and we hope they use it.
I love your emphasis on voting. As an Italian, I learned from history that not participating is very dangerous. I don't know if you know, but during the rise of fascism, the opposition decided to leave parliament in protest. And of course, Mussolini went ahead, and that was the biggest gift they could give to him. Investing and not participating is not the right strategy. But this said, I'm a little bit concerned about the incentives of the large index funds. I agree with you that the large index funds tend to have a longer, or should have a longer perspective, because they're there for the long term. However, their managers are rewarded on short-term financial performance. So how do you put the long-term objective into the manager that ran BlackRock or Vanguard or so on and so forth?
I'm not sure I have a great answer to that. But what we have seen within the stewardship teams of these firms is we have seen them start to move the right direction. I think it's the pace. Are people going to be happy with the pace of change in large organizations? I think we'll see next proxy season and the following proxy season. And hopefully what happens, and certainly one of our goals is, when we did this campaign with the thought that we could actually win, is that we inspire other people to do the same thing. The idea that other people can find great directors, they have a great argument, And they put that in front of large shareholders and give them an opportunity to really affect change. Again, they're limited because they're not going to, the big three are not going to propose their own slate of directors. Again, they can't do that without becoming active, but other people can. While I don't know, I certainly do hope that the win that we had with Exxon gets other people to look at other industries and other companies who have been recalcitrant on how much their impacts have affected shareholders and stakeholders, and put forth people that really want to affect change in multiple industries. That's what we would like to see.
Sorry, why isn't the answer that as people get to know what these funds are doing, they might vote with their feet? BlackRock, until recently, has been very, especially Larry Fink, has been very active in words, but when it comes to votes, and the case of Exxon is a noticeable exception, but in case of voting, the voting record of BlackRock was terrible on environmental issues. When you provide an alternative, an index fund that actually vote in the way people care, you're going to get the same performance. If you have an index funds that is indexed to the S&P 500 but vote pro-environment, will have exactly the same performance as a BlackRock 500, but your vote goes in the right direction. And so that pressure might induce these guys to go in the right direction, as long as we investors, small investors, know that and vote with our feet.
Yes, I mean, I think the reason we are certainly offering an index fund is to try to capture people who believe the change needs to happen faster than it actually has been happening, and they have the ability to know with a large degree of certainty, because of the transparency we were providing on how we're going to vote, how we are going to try to affect change. But I also think, though, we can't lose sight of we have seen so far. Exxon, when we started the campaign, was a $30-something stock. I mean, our cost basis is like $36. The stock is over 60, and there are 4 billion shares outstanding. So think about the value that has been created for all index managers, because they think that maybe with a few directors that have energy experience, they can improve the performance of a company. So I do think that the idea that we can actually improve the index performance is kind of one of our core tenets. And there's, of course, as a University of Chicago guy, I'm sure you may bring up the free rider problem associated with that, but we're willing to accept that, because we do think that this is an opportunity, because of the data, the ESG data revolution, to really take into account a better way for these companies to be run. So, I mean, there's already been, I've been lucky enough to see how the investment banks are positioning themselves as potential advisors to many large companies. What ESG criteria are going to be important to shareholders, and how can they prevent an activist to come with a ESG mandate to change out board members? And so the fact that this is now going to be a discussion point because of the Exxon, it already means that we have sped up the pace of change dramatically from where we were before. So it is unclear exactly all the ways in which we're going to see potentially the system change. But we know it's moving in the right direction, and we know it's going to move a lot faster because of the win that we saw with our 3 directors.
I know one issue that has frustrated investors for a long time is the lack of a link between executive compensation and performance. Is that an issue that you explicitly plan to take on, or do you plan to take it on more indirectly?
I do think that was an important part of our messaging, and one that we saw resonate extremely well with investors. And certainly when you have things like cut 401k matching programs for employees, and CEOs still get more shares than they had before when the stock is down a ton. This linkage and the G portion of this, which frankly, I underestimated before getting into this campaign. I didn't really understand to a full extent to what role governance, which obviously compensation is a component of, could play, and shareholders' inability to restore the equilibrium between themselves and management is directly tied to the governance component of this. And when you have a chairman and CEO combined, their ability to restrict data flow to boards, and what boards actually end up knowing about the company is much smaller. And therefore, there's much less oversight when you have a chairman CEO. So I do think that executive compensation as a component of this, it's the one that really gets shareholders most bent out of shape when they see management teams make money while they're losing money. So that's always going to be a tool, but it's part of a broader governance issue that exists across, across U.S. companies. And I've read enough of your work around crony capitalism, and those components are certainly true in large companies in the U.S. And we certainly hope that changes, because if it doesn't change, the direction that we're going to go is completely the wrong direction, which is towards a like we see today, the polling among millennials and on why they think socialism is a good idea. Well, they think it's a good idea because capitalism isn't working for them and isn't working the way it should. And a large part of that is because of this governance issue that exists in large companies right now.
Yeah, I completely agree. And you pointed out a very important point that is often forgotten is how much boards get served a prepared menu by the chairman CEO. And actually, on this dimension, the role that the media can play in informing board members of a different story. I've been on boards of large companies, and I found media report very useful because they give you an opportunity to ask a question inside a board that you will not have the possibility of asking. And once you ask the question, then you turn the table because you are the one asking question, not the one receiving the prepared information.
This was a hallmark, by the way, and there was a lot of CEOs that I spoke to during the course of this process, and one told me the story of General Electric, and GE was the master of how to effectively punish the board members for asking any questions. And over time, what they did is they created a system of so much actual paperwork over the board day and a half meeting, and so many things that they had to approve in a way that didn't require debate, that's really all they had time for during the board meetings. And so they would go there. There was a process. There was virtually no discussion about the business. There was a lot of actual formalities, and they left the board meeting knowing virtually no more about General Electric than they did before the board meeting. And I think many large companies have gone down the route of putting board members on their board who are not going to question management, are not going to push back. It's not a secret that in many cases, the chairman CEO picked the other board members. Governance, the nomination committee is very much tied to the chairman CEO. And so therefore they have all friendlies on the board. And then they put an enormous amount of paperwork in front of them over the course of the board meeting. And guess what? There's no real change.
Speaking of socialists, I always joke that board election in the United States is the closest thing to Soviet election in the Western world.
Exactly. Oh, it's 100%. That is completely true. And it's really, it's not the right answer for anybody. It's not the right answer for the system. It's not the right answer for the companies. And the only reason you do that is you have a culture that is insular and one where you don't like to be questioned. That's not going to get us to the best result. And I think we've seen this way too much recently among large companies where they don't have a board that's really going to push back.
It's fascinating given the trajectory of GE, right? That should be a warning sign to companies everywhere that this is not the right way to go. A last quick question for you, and I know you have to go, and it comes back to what we had talked about earlier. How much support do you think there is broadly among investors for issues that are purely ideological and that aren't economic in the end?
I don't think there's a lot of support for ideas that are only ideological, unless you can tie them back to economic outcomes. I mean, the shareholders vote, and the shareholders are going to vote what they think is in the best long-term interest of the company. But if you can't link an ideological argument to an economic argument, then it's probably not something that should be put to vote anyway. So I think that linkage it occurs over the long term in many cases, and so therefore you can do that. But I don't think there's I personally don't think there's a way to affect change in the duration. It's probably not the market's job to do that. It's probably government's job to do that if you can't tie it to economic terms.
That is great. Thank you very much for your time, and good luck with your strategy. We hope you succeed.
Okay, thank you very much.
I suspect that a lot of our listeners have no idea how board members are elected. And this is actually something extremely important and that receives very little attention, even among my colleagues, economists. And I think they receive a lot of attention because it's not a pleasant thing to actually advertise very much. You are the incumbents, having a committee of the incumbents make a proposal of who is going to be elected in the future. And this list goes up, and if there are 9 seats on the board, there are 9 people candidate. So either you are elected or you are elected. And in fact, most of the time, even if you don't get a plurality of the vote to be elected, you are co-opted by the board afterward. So basically, it's completely an incumbent decision to renew their friends on the board for the next time around. So the interesting thing that Engine One did is to try to add new seats to the board and bring new people to the board. In order to do that, you have to mail your own proxy, you have to make your own campaign, you have to spend a lot of money. The interesting thing is this is the ultimate phenomenon that we economists call free rider problem, because you spend your own money, but to the benefit of all the shareholders. So unless you have enough shares in the company and the company gets an important capital gain, you don't recover your investment. Now, in this particular case, Chris James seems to have done well because collected enough shares of Exxon and Exxon's increased enough that he more than paid for the $12.5 million that he spent to actually win these three seats on the board. But in general, it's not a very profitable strategy.
Makes a lot of sense to me, and I see why Chris James was so drawn to it, particularly with Exxon, because part of his argument was that not only that Exxon was losing a lot of money in traditional oil and gas, but that their lack of renewable strategy for the future was going to hurt the environment, but also hurt their chances of being profitable later on. Yes, these are broader societal issues, but issues that needed to be tackled at the corporate level for Exxon even to continue to be successful. Forget about even maximizing the success around the issue. It's both, right?
No, you're absolutely right. The only difference is because we are economists, we tend to put everything in terms of trade-offs. So shareholders might be willing to sacrifice some of their profits to have a better environment. Now, Chris James, who is a successful manager, is more in the business of win and win solutions. So he points out that you can do both at the same time. And if you can, kudos to him, that is great. Okay, we have a more difficult world in which you have to trade one against the other. But I was discussing with my co-author, Oliver Hart, what Chris said and how to interpret in light of our model. I think that the simplest idea is Exxon was poorly managed, and you could have two kinds of takeovers, one that was maximizing profits and one that was maximizing something more than just the profits, like Chris James is doing. And it looks like Chris James' strategy is also very effective from a marketing point of view, because I was reading that they had budgeted almost $30 million for the proxy fight, and they ended up spending only $12.5 million, which it's a bargain, not for you and I, Bethany, but for large investor, it's a bargain. And part of it is actually, ironically, COVID, that you didn't need to travel to talk to so many people. But the other, that's my interpretation, is that this strategy makes it more appealing to a lot of people. It makes it more appealing because people do care about things other than just profits.
I'm not so sure about that. I thought after our conversation that the strategy was less revolutionary than appeared on the surface. I thought that Chris was quite almost Friedman-esque in some of his final remarks, where he said that the business of a company is to make money. I don't think he was driving a wedge between the idea of making money and the idea of doing something good for society. I think his point of view is that a lot of times those two things are aligned, and the issue in our capital markets is more one of timing, short-term versus long-term. And as long as you can convince investors to be sufficiently long-term oriented, then the actions that engine number one wants to take will be in the long-term economic interests of those shareholders. But what I did not hear him say, in fact, I heard him say he would not do this, was take on ideological or social issues that didn't have the potential to make money or prevent a company from losing money either. So even though what he's doing is really, really interesting, and I applaud it, I think it is actually more Friedman-esque than less Friedman-esque, and I think it is less revolutionary than I had thought at first.
I partially agree with you, and it's definitely the case that he wants to make money, and that this is also a very good marketing strategy to raise money and make money. And this is not past him. But I think that one of the reasons why it is such a good strategy is because some investors actually do care also about the environment. Imagine you can have two different investors running your money, and one can be an old Carol Icahn or doing a takeover of Exxon and trying to restructure, or to have Chris James. I think that Chris James looks more appealing today and is more likely to win a larger consensus by having that strategy. In fact, the crucial point is the reason why he was so successful is because the large index funds voted for him eventually. So Vanguard, Fidelity, BlackRock, those guys count for a lot, and they are shaped by very few people who make that decision. And whether it is simply the ISS and Glass Lewis of this world, the proxy advisory firms, or they are the governance department of BlackRock, but a few people decide on the votes of millions of shareholders, and they count for a lot. And these people can be more easily won with a combination of make money and make good than just with either make money or make good.
I think I'm still going to disagree with you a little bit, and I want to come back to the index fund issue. But my point was not that this doesn't have a lot of utility, that the Chris James model doesn't have a lot of utility for climate change. I think it does, because arguably you could make a very broad economic argument that if we don't fix climate change, we're all screwed economically. I think what I heard Chris say, and my takeaway, is that it is less broadly useful than I might have thought going into the conversation. In other words, climate change, you can make an argument, is an economic issue that is going to affect all of us. Other social issues, the link to the economics of it, are not as clear. And what I heard him say is that he would not be interested in those sort of topics. So this isn't a mechanism for taking on social issues as much as it is a mechanism for taking on social issues that also have broad and pretty obvious and pretty broadly compelling financial ramifications. And in that sense, it's a more limited strategy than I might have thought firsthand. But I totally agree with you about index funds, and I think that's part and parcel of this conversation, which is Larry Fink at BlackRock, for instance, has been very outspoken about the issue of climate change, and this played right into something that he already believed. But Chris himself was a little bit cynical about the idea that index funds were going to be forces for change rather than forces for the status quo. And so I think he understands what he's up against there, that in other words, the specific dynamics of the ExxonMobil situation may be hard to repeat.
I completely agree. I think that he was very smart in packaging the entire thing together in the Exxon case. Exxon board was particularly asleep at the wheel. But I think that what is important, once you see a phenomenon like Exxon, this will have a ripple effect on all the major corporate boards, because the CEOs will start to panic. They are going to see how to prevent a future attack from Chris James. We're going to see a lot of people at least paying lip service to the environment, etc., in order to block even that angle.
Is that a good or a bad thing if we see more people paying lip service to an idea more than more people actually doing something about it?
We hope that there is something behind the lip service. This is what I think that ideally the press and academia should expose if they pay lip service, but not with no substance.
Have you ever wondered what goes on inside a black hole? Or why time only moves in one direction? Or what is really so weird about quantum mechanics? Well, then you should listen to Why This Universe. On this podcast, you'll hear about the strangest and most interesting ideas in physics, broken down by physicists Dan Hooper and Shalma Wegsman. If you want to learn about our universe, from the quantum to the cosmic, you won't want to miss Why This Universe, part of the University of Chicago Podcast Network. I thought Chris made a couple of other really good points that were surprising and interesting to me, too. And it might tie into this idea for you that boards are going to take a look at their own composition and their own activities and say, uh-oh. But one idea was that on a lot of boards, you don't have industry expertise, that on the ExxonMobil board, you didn't have people with oil and gas experience. I have to admit, even after whatever it's been, oh dear God, a quarter century of covering business. I hate to say that. It makes me sound old. I am old, whatever. I was totally shocked by that. I would have thought I'd never looked at it, but I would have thought at least half the people on that board had to come from the oil and gas industry. And I was stunned by that. I also thought the example he pulled forward about General Electric and the way the board was drowned in paper and drowned in paperwork in order to prevent them from even seeing substantive issues, let alone raising them, and that it was a deliberate strategy employed to keep the board sort of neutered. I thought that was completely fascinating, a completely fascinating insight too, and one that I had not thought about before. I actually always thought it was more social dynamics at the board of directors, either ignorance or social dynamics at the board of directors that kept boards from raising issues that perhaps they should have. I had never thought it was actually a deliberate strategy by corporate management. I'm so naive. Were you surprised too, or did you expect those things?
No, having been on boards, I can say that I wasn't surprised at all. I think there is a art of good chairman to basically do it without giving the appearance of doing it. And I think if you are an experienced board member, you limit the amount of information that they give you on purpose, precisely because you want them to take responsibility on what they give you or not, rather than covering with a lot of stuff. The other that I learned is the paper you read first is the last one to arrive on your desk. The stuff that they send you like 3 weeks in advance, you know there is nothing in it. The stuff that arrives by email 2 hours before the board, that's where you have to pay all the attention, because that's where the bodies are buried.
Okay, so here's a question I was struggling with. As we talked about, I do think that oil and gas, climate change issues are absolutely right for Chris James's strategy. And really, to be fair to him, if he does nothing other than tackle this issue, get companies to tackle it, that's a lot. But can you think of anything where the social goals and the long-term economic goals line up so clearly? I was trying to think of other social issues or other causes where there might be tight alignment between the economic endpoints and the social goals. And I admit I was coming up a little short.
Actually, I don't think so. So think about social media, for example. If I interpret correctly, Chris James' strategy is to say, if you are doing something that society doesn't like, eventually you're going to have the government after you, you're going to have the consumer unsatisfied, you're going to have the worker complaining. It's not going to be a good business long term. That's his proposition. I would like to see the numbers to trust that this is always the case, or most of the time the case. I would like to believe so, however. Certainly in the very long term, it's hard to imagine that this is a great strategy. In a sense, is a broader version. Have you heard this term of the Net Promoter Score? Is a marketing concept that people have used with a lot of success. Is a difference between the customers that really love you and the customers that hate you. And I think that industries that have a bad, companies particularly, but also industries that have a very low Net Promoter Scores are ripe for change. So Comcast has probably has probably a super negative Net Promoter Score because nobody likes Comcast. And actually, I love Matt Stoller that came up and said the worst sentence in the American language is, "I'm from Comcast and I'm here to help." But that is an industry that that people are upset. They find every way to bypass, and eventually innovation will find a way to do it. Think about the cab industry. There was a lot of discontent for the way the medallion system was working, but for whatever reason, it was very difficult to have a change. And then you had the Uber revolution with all the problems of Uber, but basically impacted that industry massively. And if you were older on medallion, you took a big loss.
That's interesting. I think you or somebody else should write a paper and see if there is a correlation between that and eventual economic decline, if one thing does lead to the other. And then if it does lead to the other, if it is a predictor of eventual economic decline, then you could make the case to Chris James that his mandate should be even broader, because these companies that are making enemies are eventually destined to fail. I've always believed that on some level, on a micro level. And what I mean by that is when I think about companies I've covered that have been spectacular failures from Enron to Fannie Mae, they were always companies that were making enemies, that were hated. And when they got into trouble, no one came to their rescue. But that's been my anecdotal journalistic observation rather than anything more scientific. And I don't know if it applies broadly to industries as a whole that are making enemies. I mean, for sure, that has not been true of big tech until now. Big tech has been making enemies. I mean, at least, I don't know, when do you trace it to? Do you trace it to the election of Donald Trump with Facebook? And certainly, if it is leading to enemies for Facebook, that is not showing up in their stock price. Although I guess that's hard to measure, because you could say maybe their stock price would be even higher if it weren't for some of the enemies that they've made. But it's not showing up in their financial performance. And so there is for sure a lag time in your proposition.
No, that's what makes it difficult to test, is there is a lag time, and it's not obvious how long this lag is. As Ken said, in the long term, we are all dead. So eventually, I think all companies will be dead. So it's a bit tricky to test. However, I think that it's interesting for the digital platforms, because I think they produce an enormous amount of consensus at the beginning. The Net Promoter Score was off the chart. People love Google, love also Facebook, but particularly Google. And part of it is because they were providing so much value to consumers. Regulators could not touch them. Even journalists could not touch them. I think things have changed. Certainly, they started to change with the election of Trump, even if what they have done is no worse or better than what they did when Obama was elected. It's just that people did not like it.
Maybe true. I always think whenever somebody says we'll all be dead, and in the long term we'll all be dead, I always think of my sister's variation on that, which always makes me laugh, which is it's all going to be fine in the end. And if it's not fine, it's not the end. I don't know why that always makes me laugh. Anyway, it's probably not really funny. But anyway, so I was wondering both, and back to this conversation about index funds, I thought there are limits that Chris is imposing on his own strategy in terms of the need for it to be economically viable as well as in the right interests of society. But I thought there are two limits that are going to get posed on him externally. One is the issue of index funds. When will they put their foot down? When will they weigh in? And the other issue that I thought is going to be a big one for him, which we addressed a little bit, is the issue of timing. Because, and you, I thought, asked him a really great question on that. But so many people, their compensation in all aspects of this thing we call the market is oriented toward the short term. If you're a portfolio manager, your compensation is oriented toward how your portfolio did over the last year. If you're an investor, you care about how your portfolio did over the last year. And it's artificial and it's stupid, but here we are. And some part of his strategy depends on getting people to give a damn about the long term again. And I think we've moved so far away from that I wonder if it's not a big, popular, major issue like climate change, how much of a difference can you actually, how much movement can you actually get?
I actually am a bit more optimistic than you are, precisely coming from the index funds, because at the end of the day, if I invest in an S&P 500 index, I'm going to get the return of the S&P 500 index, at which point I might be tempted to actually vote for things I care deeply about. So if we open up a way for investors to communicate their preferences to institutional investors will be forced to communicate to companies, and that will have more of an impact than we expect. I think that the big risk that we saw hugely under the Trump administration with Clayton at the SEC, we will see what Gensler does now, is that the regulators come in the picture to stop this process, because corporate America does not want to be told what to do. They want to make sure that you give them your money, but you don't give them your voice, because they like your money but don't like your opinions. And what is the best way to do it? Is to block this system of proxy advisory, proxy voting, and all the stuff. And it's very easy to have a couple of small rules that change the ability of all of us to express our opinion.
That's really interesting. Well, then I guess maybe we should be grateful, I think, that Chris James is launching this in the Biden administration rather than in a Republican administration, which might have been more tempted to sneak little changes into some of the rules that would have made it much harder for this sort of tactic to succeed. But you can bet that in investment banking boardrooms everywhere, do you remember back in the late 1980s when the whole defense of takeovers, the green mail thing was a whole strategy that every investment bank had? You can bet bet they're coming up with a Chris James strategy for how you prevent this from ever happening again, to implement it company after company. And the big law firms are all working on it. And any loophole that exists or doesn't exist is getting closed.
However, the fun part is they contribute in making Chris' ultimate strategy more successful, because they go out scaring the hell out of the board members. That's why they make money. They go out and say, oh, the war is ending, you need our advice to how to fight and then how to prevent, how to do this, how to do that. But at least in part, that strategy must include do something, for example, for climate change.
I hope you're right. I tend to be a little bit more cynical, but you know what? We shall see, and I certainly wish him the best of luck.
Capital Isn't is a podcast from the University of Chicago Stiegler Center in collaboration with the Chicago Booth Review. Also check out promarket.org, a publication of the Stiegler Center. Don't forget to subscribe and leave a review to Capital Isn't wherever you get your podcasts.